Question 1. Which of the following is a characteristic unique to variable annuities compared to fixed annuities? A. Guaranteed fixed payout amounts. B. Investment risk borne by the insurance company. C. Sub-account allocations linked to investment options. D. No charges associated with withdrawals before age 59. 1, 2. Answer. C. Sub-account allocations linked to investment options. Explanation. Variable annuities differ from fixed annuities in that the value of the annuity can fluctuate based on the performance of underlying investments. In a variable annuity, the policyholder can allocate premiums among various sub-accounts, which are typically mutual funds or other investment portfolios. This exposes the policyholder to investment risk, meaning the annuity's value and future payouts depend on the market performance of the chosen investments. A. Fixed annuities provide a guaranteed payout regardless of market performance, which is not the case in variable annuities. B. In fixed annuities, the insurance company bears the investment risk, while in variable annuities, the policyholder assumes the investment risk. D. Early withdrawal penalties before age 59. 1, 2 apply to both types of annuities due to IRS regulations, not just variable annuities. Question 2. Mr. Davis, a 58-year-old investor, is interested in purchasing an annuity to provide steady retirement income. He is concerned about market volatility and wants to ensure that his payout will be predictable. Which type of annuity would best meet Mr. Davis's needs? A. Fixed annuity. B. Variable annuity. C. Fixed indexed annuity. D. Deferred annuity. Answer. A. Fixed annuity. Explanation. A fixed annuity guarantees a specific, predictable income stream, making it suitable for individuals who seek stability and protection from market volatility. This makes a fixed annuity the best choice for Mr. Davis, as it will provide him with guaranteed, regular payouts. B. A variable annuity involves exposure to market fluctuations, which means the payout can vary based on the performance of underlying investments. This would not meet Mr. Davis's desire for predictability. C. A fixed indexed annuity offers some potential for growth based on a stock market index, but it also involves a degree of market exposure and does not guarantee fixed payouts. D. A deferred annuity defers income payments until a later date. While it could be an option for future income, it would not address Mr. Davis's immediate need for predictable income now. Question 3. Which of the following is a requirement under the NAIC Suitability and Annuity Transactions Model Regulation when recommending an annuity to a consumer? A. Producers must recommend annuities that maximize the insurer's profitability. B. Producers must consider the financial status, age, and risk tolerance of the consumer. C. Producers must recommend a fixed annuity for all clients under the age of 60. D. Producers are not required to disclose commissions earned from the sale of annuities. Answer. B. Producers must consider the financial status, age, and risk tolerance of the consumer. Explanation. The NAIC Suitability and Annuity Transactions Model Regulation requires that producers thoroughly assess the financial situation, age, and risk tolerance of the consumer before recommending an annuity. The goal is to ensure that the recommended product aligns with the consumer's needs and financial objectives, reducing the risk of selling unsuitable products. A. The regulation focuses on the suitability of the product for the consumer, not the insurer's profitability. C. There is no requirement to recommend fixed annuities for consumers under the age of 60. The choice should be based on the individual's needs, goals, and circumstances. D. Producers are required to disclose commissions and compensation related to the sale of annuities, ensuring transparency and avoiding conflicts of interest. Question 4. Which of the following is a key feature of a deferred annuity? A. Immediate payout of benefits after the annuity is purchased. B. The accumulation phase followed by a distribution phase. C. Payments begin after a fixed period of time but are not flexible. D. No death benefits are provided to beneficiaries. Answer. B. The accumulation phase followed by a distribution phase. Explanation. A deferred annuity involves two distinct phases: the accumulation phase, during which the policyholder's contributions grow, and the distribution phase, when the annuity starts paying out. The key characteristic of a deferred annuity is that it does not begin payouts immediately, but rather after a specified deferral period. This is a characteristic of immediate annuities, which begin payouts right after the premium is paid. C. While payments in a deferred annuity may begin at a predetermined date, they are not inherently inflexible. The timing of payments is simply delayed, but there are different types of flexible payment options. D. Deferred annuities often include death benefits for beneficiaries, which can be part of the contract terms. Question 5. A variable annuities sub-accounts are typically linked to which of the following investment types? A. Fixed interest bonds. B. Mutual funds and stock portfolios. C. Treasury bills. D. Bank savings accounts. Answer: B. Mutual funds and stock portfolios. Explanation: variable annuities allow policyholders to invest their premiums in sub-accounts, which typically consist of mutual funds or other investment portfolios linked to stocks, bonds, or other assets. The performance of these investments determines the value of the annuity and future payouts. A. Fixed interest bonds are not typically used as sub-accounts in variable annuities, which focus on investments with growth potential. C. Treasury bills are low-risk, short-term government securities, not commonly found as sub-accounts in variable annuities. D. Bank savings accounts are not used in the structure of variable annuities since they do not offer the potential for growth that is characteristic of sub-accounts linked to mutual funds or stock portfolios. Question 6. Which of the following is an example of a rider that can be attached to an annuity contract to provide additional benefits? A. Guarantee minimum withdrawal benefit. Inflation protection benefit. C. Short-term disability rider. D. Fixed interest rate rider. Answer: A. Guaranteed minimum withdrawal benefit. Explanation: a guaranteed minimum withdrawal benefit, a common rider attached to annuity contracts. It guarantees the policyholder can withdraw a certain amount each year, regardless of market performance, even if the annuity's account value falls below the guaranteed amount. B. While an inflation protection rider can be applied to some annuities, it is not a standard annuity rider like GMWB. C. Short-term disability riders are typically applied to life insurance policies or health insurance, not annuities. D. Fixed interest rate riders are not typical for annuities, as annuities often offer variable or guaranteed growth depending on the type. Question 7. What is the primary advantage of a fixed indexed annuity compared to a traditional fixed annuity? A. It provides a guaranteed return based on stock market performance. B. It offers a fixed return regardless of the stock market's performance. C. It offers the potential for higher returns by linking interest credits to a stock market index. D. Is entirely free from market risk and guarantees higher interest rates than fixed annuities. Answer: C. It offers the potential for higher returns by linking interest credits to a stock market index. Explanation: a fixed indexed annuity is designed to provide the potential for higher returns by tying interest credits to the performance of a stock market index, e.g. SP 500, while still offering a minimum guaranteed return. This allows the policyholder to benefit from market growth without exposing them to the full risk of market losses. It does not directly provide a guaranteed return based on market performance. It offers interest based on the performance of an index, but it is not a direct investment in the market. B. This is characteristic of a fixed annuity, which offers a guaranteed return regardless of market performance, unlike fixed indexed annuities. D. Fixed indexed annuities are not free from market risk while they have a minimum guaranteed return. The index-linked return is subject to cap rates, spreads, or participation rates, limiting the potential for high returns. Question 8. What must be disclosed to a consumer when replacing an existing annuity with a new one? A. The producer's commission and compensation for the sale of the new annuity. B. The total amount the consumer will pay in fees over the life of the new annuity. C. A comparison of the new annuity's features, benefits, and risks compared to the existing one. D. The availability of death benefits for the new annuity. Answer: C. A comparison of the new annuity's features, benefits, and risks compared to the existing one. Explanation: when replacing an existing annuity, it is required that producers provide a thorough comparison between the existing annuity and the proposed replacement. This includes features, benefits, risks, and costs, ensuring the consumer understands the implications of replacing the annuity. This is part of the suitability and disclosure requirements under the NAIC Suitability and Annuity Transactions Model Regulation. While commissions and compensation must be disclosed to the consumer, this is not the primary requirement when replacing an annuity. B. The total fees over the life of the annuity are important but are part of the broader discussion about the annuity's features, not the sole focus. D. Death benefits are a common feature in many annuities, but they are only one part of the overall comparison. Question 9. Mr. Thompson, a 65-year-old retiree, wants to create a predictable income stream for the rest of his life and is considering annuity options. Which of the following annuities would best meet Mr. Thompson's needs? A. Fixed annuity with a lifetime income rider. B. Variable annuity with a guaranteed minimum withdrawal benefit. C. Immediate annuity with a period certain option. D. Deferred annuity with a surrender charge. Answer: a fixed annuity with a lifetime income rider. Explanation: a fixed annuity with a lifetime income rider would guarantee Mr. Thompson a steady, predictable income for as long as he lives, addressing his desire for financial security in retirement. The lifetime income rider adds an additional layer of protection, ensuring income for the duration of his life, even if the account value falls to zero. B. A variable annuity with a guaranteed minimum withdrawal benefit would still expose Mr. Thompson to market fluctuations, which may not be ideal for someone seeking predictability. C. An immediate annuity with a period certain option guarantees payments for a set number of years but does not provide lifelong payments, which is important for Mr. Thompson. D. A deferred annuity would not begin payments until a later date, which is not suitable for Mr. Thompson's immediate retirement income needs. Question 10. Which of the following best describes the main risk associated with purchasing a variable annuity? A. The policyholder is guaranteed to lose money if the stock market performs poorly. B. The value of the annuity depends on the performance of underlying investments, meaning returns are uncertain. C. The policyholder is guaranteed a fixed, predetermined return regardless of market conditions. D. The policyholder is guaranteed to receive income payments for a fixed period regardless of market conditions. Answer: B. The value of the annuity depends on the performance of underlying investments, meaning returns are uncertain. Explanation: in a variable annuity, the value depends on the performance of the investments chosen by the policyholder, such as mutual funds or stocks. This introduces market risk, meaning returns can fluctuate. A. The policyholder is not guaranteed to lose money. In fact, variable annuities offer the potential for growth based on market performance. C. This describes a fixed annuity where the return is guaranteed but not a variable annuity. D. This is more applicable to immediate annuities or fixed annuities, not variable annuities. Question 11. Which of the following options is not a common feature of an immediate annuity? A. The annuity begins payments immediately after the premium is paid. B. The premium is paid as a lump sum. C. The annuity guarantees income for the lifetime of the annuitant. D. The annuity allows for flexible premiums and withdrawal options. Answer: D. The annuity allows for flexible premiums and withdrawal options. Explanation: immediate annuities typically require a lump sum premium with payments starting immediately. They provide guaranteed income for life or a set period, but they do not offer flexibility in premiums or withdrawals after the contract is initiated. Correct for immediate annuities, as they begin payments soon after the premium is paid. B. Immediate annuities typically require a lump sum premium payment. C. Many immediate annuities provide guaranteed income for life, depending on the terms of the contract. Question 12. Which of the following is not a typical characteristic of a fixed annuity? A. The annuity offers guaranteed interest rates. B. The annuity provides predictable, stable income over a specified period. C. The annuity's value depends on the performance of the stock market. D. The annuity offers the option for a death benefit for beneficiaries. Answer: C. The annuity's value depends on the performance of the stock market. Explanation: fixed annuities provide a guaranteed interest rate, ensuring predictable returns. The value of a fixed annuity does not depend on the performance of the stock market, unlike a variable annuity. A. Fixed annuities offer guaranteed interest rates. B. They also provide stable income for the policyholder, often in the form of regular payments. D. Many fixed annuities include death benefits for beneficiaries. Question 13. What is a surrender charge in the context of an annuity? A. A penalty applied when the policyholder withdraws funds from the annuity before a specified period. B. The amount an annuity pays to the beneficiary upon the annuitant's death. C. The annual fee charged to the annuitant to maintain the annuity contract. D. A tax levied on the annuity's accumulated earnings. Answer: A. A penalty applied when the policyholder withdraws funds from the annuity before a specified period. Explanation: a surrender charge is a penalty that applies when the policyholder takes out money from the annuity during the early years of the contract, typically within the first few years. B. This describes a death benefit, not a surrender charge. C. The annual fee could be a part of the contract, but it's not the same as a surrender charge. D. Taxes on earnings are separate from surrender charges, though they could apply if funds are withdrawn. Question 14. Which of the following types of annuities provides income payments for a fixed period, regardless of whether the annuitant is alive or deceased? A. Life annuity with a period certain. B. Fixed annuity. C. Joint and survivor annuity. D. Period certain annuity. Answer: D. Period certain annuity. Explanation: A period certain annuity provides guaranteed income payments for a set number of years, regardless of whether the annuitant is alive or deceased. A life annuity with a period certain guarantees payments for a specified period or for the annuitant's lifetime, whichever is longer. B. A fixed annuity provides guaranteed payments but does not specify a fixed period. C. A joint and survivor annuity pays income for the lifetimes of two individuals, typically offering survivor benefits. Question 15. What is the primary purpose of an inflation protection rider in an annuity? A. To ensure the annuity's income payments increase based on changes in the consumer price index. B. To guarantee the policyholder a fixed return that is not affected by inflation. C. To adjust the annuity's interest rate based on market performance. D. To allow the policyholder to withdraw funds without penalty during periods of high inflation. Answer A. To ensure the annuity's income payments increase based on changes in the consumer price index. Explanation. An inflation protection rider is designed to increase the income payments from an annuity in line with inflation, often based on the consumer price index. This helps maintain the purchasing power of the income over time. B. Fixed returns are not affected by inflation unless an inflation protection rider is attached. C. Inflation protection does not typically involve adjustments based on market performance. D. The rider does not directly allow penalty-free withdrawals during high inflation periods. Question 16. Which of the following best describes the accumulation phase of an annuity? A. The period during which the annuity's account balance grows, often through premium payments and investment returns. B. The period during which the annuity pays out income to the annuitant. C. The period in which the annuity's death benefit is calculated. D. The period when the annuitant has access to funds without penalties. Answer A. The period during which the annuity's account balance grows, often through premium payments and investment returns. Explanation. The accumulation phase is when the annuity's value grows based on premiums paid and any investment returns. This phase lasts until the policyholder begins receiving income from the annuity. B. This describes the distribution or payout phase, not the accumulation phase. C. The death benefit may apply during any phase, but it is not the primary focus of the accumulation phase. D. Penalties for withdrawals often apply during the accumulation phase, making this incorrect. Question 17. Which of the following is an example of an annuity payout option that offers payments for the lifetime of the annuitant? A. Fixed period annuity. B. Life annuity. C. Joint and survivor annuity. D. Temporary annuity. Answer B. Life annuity. Explanation. A life annuity provides income payments for the annuitant's lifetime. This ensures that the annuitant will receive payments for as long as they live, regardless of how long that may be. A fixed period annuity provides payments for a specific period, not for life. C. A joint and survivor annuity pays for the lifetimes of two individuals, not just one. D. A temporary annuity provides payments for a set period, not for life. Question 18. Which of the following is the key advantage of a longevity annuity? A. It guarantees income for a set period, regardless of lifespan. B. It provides early payments that increase as the annuitant ages. C. It begins income payments at an advanced stage, typically after the annuitant turns 80 or 85. D. It links income payments to stock market performance. Answer C. It begins income payments at an advanced age, typically after the annuitant turns 80 or 85. Explanation. A longevity annuity is designed to begin income payments at an advanced stage, providing a steady income in retirement for individuals who live into their later years. This describes other annuity types, such as fixed or period certain annuities. B. Longevity annuities typically do not provide increasing payments. They offer a fixed income that begins later in life. D. Longevity annuities do not depend on stock market performance, so they are typically fixed income products. Question 19. Which of the following is true regarding the taxation of annuities? A. The principal portion of an annuity payout is taxed as ordinary income. B. The earnings portion of an annuity payout is subject to ordinary income tax. C. Annuity payouts are tax-free if the policyholder has reached the age of 590 onward. D. The entire payout from an annuity is taxed as capital gains income. Answer B. The earnings portion of an annuity payout is subject to ordinary income tax. Explanation. When annuity payouts are made, the earnings portion, the growth on the premiums paid, is taxed as ordinary income. The principal portion, The amount you initially paid into the annuity is not taxed because it is considered a return of your investment. A. The principal portion is not taxed as ordinary income, only the earnings are. C. The age of the policyholder does not exempt annuity payouts from taxation. However, withdrawals made before age 591 may be subject to early withdrawal penalties. D. Annuity payouts are not taxed as capital gains. They are taxed as ordinary income based on the earnings portion. Question 20. Which of the following types of annuities provides the most flexibility in terms of investment choices? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Life annuity with period set. Answer. B. Variable annuity. Explanation. A variable annuity provides the most flexibility as it allows the policyholder to choose from a variety of investment options, typically mutual funds, and the value of the annuity depends on the performance of those investments. A fixed annuity provides a guaranteed return, but it lacks flexibility in investment choices. C. An immediate annuity focuses on providing income rather than investment options. D. A life annuity with period certain guarantees payments for life or for a set period but does not involve investment flexibility. Question 21. In the context of annuities, what is a death benefit? A. A lump sum paid to the beneficiary of an annuity contract if the annuitant dies before the annuity payments begin. B. The total amount paid to the annuitant over their lifetime. C. A tax-free benefit paid to the annuitant's estate. D. A rider that increases the annuity payment in the event of the annuitant's death. Answer. A. A lump sum paid to the beneficiary of an annuity contract if the annuitant dies before the annuity payments begin. Explanation. The death benefit is typically a lump sum paid to the beneficiary if the annuitant dies during the accumulation phase before receiving any payments. B. This describes the total income paid to the annuitant, not a death benefit. C. The death benefit is generally not tax-free unless specified and it is paid to a beneficiary, not the estate. D. Some riders can increase payments under certain conditions, but a death benefit is not an increase to ongoing payments. Question 22. What is the key difference between a qualified and non-qualified annuity? A. Qualified annuities are purchased using pre-tax dollars, while non-qualified annuities are purchased using after-tax dollars. B. Qualified annuities are only available to government employees, while non-qualified annuities are available to all individuals. C. Non-qualified annuities offer guaranteed income, while qualified annuities do not. D. Qualified annuities are purchased only in the form of lump sum payments, while non-qualified annuities require periodic payments. Answer. A. Qualified annuities are purchased using pre-tax dollars, while non-qualified annuities are purchased using after-tax dollars. Explanation. The primary difference is that qualified annuities, such as those funded by IRAs or 401k plans, are purchased with pre-tax dollars, and the earnings are taxed when withdrawn. Non-qualified annuities, on the other hand, are purchased with after-tax dollars, and only the earnings portion is taxable. B. Both types of annuities can be available to anyone, not just government employees. C. Both types can offer guaranteed income depending on the specific terms of the contract. D. Both types of annuities can be purchased as lump sum or periodic payments. Question 23. What is the period certain feature of an annuity? A. The annuity guarantees income for a specific period, regardless of whether the annuitant lives or dies during that period. B. The annuity guarantees income for the life of the annuitant in a specified period after death. C. The annuity allows the annuitant to change the payout period during the contract. D. The annuity guarantees that the income payments will increase annually. Answer. A. The annuity guarantees income for a specific period, regardless of whether the annuitant lives or dies during that period. Explanation. The period certain feature guarantees that the annuity will pay income for a fixed period of time, such as 10 or 20 years. If the annuitant dies before the period ends, the remaining payments are made to a beneficiary. B. This describes a life annuity with a period certain, which guarantees income for both the annuitant's life and a specific period. C. The payout period is generally fixed in the contract and most annuities do not allow for changes. D. While some annuities may have escalating payments, the period certain feature does not necessarily include this. Question 24. Which of the following would most likely be a reason for an individual to choose a deferred annuity? A. They want immediate access to their annuity funds. B. They want to receive immediate income payments. C. They want to accumulate funds over time and receive income at a later date. D. They want their annuity to be based on stock market performance. Answer. C. They want to accumulate funds over time and receive income at a later date. Explanation. A deferred annuity allows the annuitant to accumulate funds during the accumulation phase. with income payments beginning at a later date, often when they retire. Deferred annuities are not designed for immediate access, so that's a characteristic of immediate annuities. B. Immediate annuities provide income right away, not deferred annuities. D. Whilst deferred annuities are variable and depend on stock market performance, this option focuses on the accumulation phase. Question 25. Which of the following best describes the annuitization phase of an annuity? A. The phase where the annuitant accumulates funds to be used later. B. The phase where the annuitant begins receiving periodic payments from the annuity. C. The phase where the annuity contract is cancelled and the funds are returned to the annuitant. D. The phase where the annuitant can choose new investment options for the annuity funds. Answer: B. The phase where the annuitant begins receiving periodic payments from the annuity. Explanation: the annuitization phase is the period during which the annuitant begins receiving regular payments from the annuity based on the accumulated funds. A. This describes the accumulation phase, not annuitization. C. Cancelling an annuity and receiving funds back is not part of the annuitization phase. D. Investment options are typically chosen during the accumulation phase, not the annuitization phase. Question 26. Which of the following is a characteristic of a fixed annuity? A. The annuity's payments can fluctuate based on market performance. B. The annuity guarantees a fixed payment amount over the life of the annuity. C. The annuity only provides lump sum payouts. D. The annuity allows the policyholder to change the payment structure at any time. Answer: B. The annuity guarantees a fixed payment amount over the life of the annuity. Explanation: fixed annuities provide predictable, guaranteed payments to the annuitant. This describes a variable annuity, not a fixed annuity. C. Fixed annuities provide periodic payments, not just lump sums. D. Fixed annuities do not allow for changes in the payment structure once the contract is in place. Question 27. What is the surrender charge in an annuity contract? A. A penalty fee charged if the annuitant decides to take a lump sum payout before a certain period. B. A fee charged by the insurer for the administration of the annuity. C. A fee paid to the beneficiary upon the annuitant's death. D. A tax on annuity earnings if the annuitant withdraws funds early. Answer: A. A penalty fee charged if the annuitant decides to take a lump sum payout before a certain period. Explanation: the surrender charge is a penalty fee that applies when the annuitant withdraws funds before a specified period, typically during the early years of the annuity contract. B. The administration fee is separate from the surrender charge. C. The fee paid to the beneficiary is not related to the surrender charge. D. Taxes may apply on early withdrawals, but they are separate from surrender charges. Question 20. Which of the following types of annuities provides payments to the annuitant for their entire life, regardless of how long they live? A. Fixed annuity. B. Life annuity. C. Immediate annuity. D. Life annuity with period set. Answer: B. Life annuity. Explanation: a life annuity guarantees payments for the annuitant's lifetime, no matter how long they live. A fixed annuity refers to the type of payment structure but does not guarantee payments for life. C. An immediate annuity provides payments starting immediately but may not guarantee payments for life. D. A life annuity with a period certain guarantees payments for life or a set period, whichever is longer. Question 29. Which of the following statements is true about variable annuities? A. They guarantee a fixed payment amount regardless of market conditions. B. They allow the annuitant to invest in a variety of investment options, such as mutual funds. C. They provide payments that are based only on the insurance company's general account. D. They do not offer the option to take lump sum withdrawals. Answer: B. They allow the annuitant to invest in a variety of investment options, such as mutual funds. Explanation: variable annuities give the annuitant the ability to invest in various options, such as mutual funds, with the value of the annuity fluctuating based on the performance of these investments. A. This describes a fixed annuity, not a variable annuity. C. Payments from variable annuities depend on the performance of the investments in the separate account, not the general account. D. Variable annuities typically allow for lump sum withdrawals, though they may be subject to penalties. Question 30. Which of the following describes a joint and survivor annuity? A. An annuity that pays out until both annuitants have passed away. B. An annuity that provides payments for a set period regardless of the annuitant's life. C. An annuity that pays the surviving spouse a reduced income after the primary annuitant dies. D. An annuity that is designed only for married couples. And so, A. An annuity that pays out until both annuitants have passed away. Explanation. A joint and survivor annuity continues making payments as long as one of the annuitants is alive, typically providing payments to a surviving spouse after the first annuitant's death. B. This describes a period-certain annuity. C. The surviving spouse in a joint and survivor annuity may receive full or reduced payments depending on the terms of the contract. D. Although commonly used by married couples, joint and survivor annuities are not exclusively designed for them.